The ceiling for gold, the next level is about 4,100, 4,080, 4,100. So that's kind of where we should be looking for that next upside target. If we look, it's about 9-10%. That's a Fibonacci measured move where it should run into a little bit of resistance. As an investor, the key is to identify on how long of a picture you want to focus on is when do you decide it is in a new downtrend and to get out. Now, I think gold would have to have a lot of damage to kind of signal we're in a bear market. It's probably going to have to you break below this level or break even below this level before I'd say, hey, gold has put in a massive top. If it sells off and puts in a head and shoulders or a bearish pattern and then starts to break down. So you don't know. A bull and bear market require a lot of time and a lot of price movement to really shift that trend. And
gold's recent rally has captured the attention of investors worldwide, pushing toward the $4,100 level, a target drawn from Fibonacci extensions and bullish technical patterns. The momentum has been extraordinary, but as history shows, such parabolic moves rarely continue without sharp pullbacks or consolidation. Price action remains the ultimate guide. Higher highs and higher lows confirm strength, while any breakdown below key moving averages could shift sentiment. With the 150-day and 50-day averages trending upward, the long-term trend remains firmly intact. But investors must stay disciplined, watching for signs of exhaustion or bearish patterns, as crowded trades can reverse violently and trap latecomers. ChrisVermeulen, founder of the Technical Traders, argues that gold's structure remains bullish, supported by strong capital inflows. However, the speed of this advance demands caution. Investors should prepare for both short-term volatility and the potential for long-term gains. Now, we present the clips from ChrisVermeulen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The number one thing is price action. Is it still trending higher? More or less, I don't have the 150-day moving average, but I can actually convert this one over to one. So if you were to take a look at like a 150-day moving average, generally, if price is above the 150-day, which is the blue line, and the blue line is sloping up, you're generally in a bull market environment. So, you need a lot of damage in gold. Generally, the 150-day moving average is telling us the long-term cycle, the long-term money flows. You want price above it. When price is above it, it means you're in a strong long-term uptrend. There's a big tailwind. And along the way, there'll be a series of rallies and pauses where it rallies up. It gets a little too far above the 150-day. It'll take a bit of a breather. It'll rally back up. It'll take a breather. It'll rally. So you want price above the 150-day moving average. In fact, you want it really above the 50-day as well, the short term. But as an investor, the key is to identify on how long of a picture you want to focus on is when do you decide it is in a new downtrend and to get out. Now, I think gold would have to have a lot of damage to kind of signal we're in a bear market. It's probably going to have to you break below this level or break even below this level before I'd say, hey, gold has put in a massive top. If it sells off and puts in a head and shoulders or a bearish pattern and then starts to break down. So you don't know. A bull and bear market require a lot of time and a lot of price movement to really shift that trend. And I mean, I don't trade so much on the bull and bear market side because there's a lot of volatility in there. I focus on the shorter term daily chart and the 20-day moving average. So the key, though, is just identify the price action. Is price making a series of, on average, higher highs and higher lows? And if it is, then it's in an uptrend. If it starts to make lower highs and lower lows, lower highs and lower lows, then you're in a downtrend. So price is the number one indicator to figure out which way it's going. And then you need position management. If it drops to a certain percentage, you should get out, protect your capital. But really it comes down to price action. And you just have to decide, are you like a short-term swing trading strategy? Are you like a position trading strategy, which could last a few months? Or are you a long-term investor really going for that bull or bear market type of trends only? I mean, if something gets overextended too far away from a moving average, usually it wants to pull back and revert back to the moving average. You can see a good example is, well, the S&P 500 doing this right now, but the 20-day moving average, gold likes to move up the 20-day moving average. Most assets do. There's a 20-day kind of cycle that goes in there. Look at the S&P 500 since the lows in April. It just bounces up the 20-day. So this is kind of like the reversion to the mean. It wants to just take a bit of a pause or breather, find some support near a moving average, and start to bounce higher. And gold has been doing that. When we look at the long-term picture chart of gold here, you can see that when it does get a little far away from the 150-day moving average, it trades sideways for a while. So the 150-day can somewhat catch up. And then it gets stretched a little too far away, and then it takes a breather, lets the moving average, it needs time to consolidate. And so it just kind of happens over and over again. This is very bullish price action. You want to see price rally, pause. These are a series of what are called bull flag patterns. They point to higher pricing. They give us upside targets. So just because it's above a moving average doesn't matter. Maybe if it's too far. If you go back in time and say every time gold rallies, roughly 15% from that moving average, maybe it needs to revert to the mean. It needs to let the moving average catch up. We could go back over here. Here's another, 15, 12%. It has a multiple series as they move up, the values change, but you kind of need these same levels, right? That's how I would look at it. There's definitely been a very nice run. I mean, just looking at the gold chart of this last consolidation and then this run up to this bull flag pattern, using technical analysis, Fibonacci extension, gold has had a perfect move so far. So just based on the way the universe works, using Fibonacci sequence, we have a move up, we have a move down, and based on Fibonacci sequence, we should expect price to run up to the 618. This is called the golden ratio. If you don't know much about Fibonacci, go look it up. It is extremely powerful. And my general rule is if price pauses at the 618 level, then we almost always go up to the 100% measured move afterwards. So I have about 4,100 as the next upside target for gold. We've had this nice run. You and I actually talked about this level last time we were on. And that's kind of where gold is headed. I think we're going to see it potentially hit 41. It could actually blow past it. But you make a really good point, David, that, we have seen this massive move in the precious metals space, and the monthly chart gives us a really good view of just how much this thing has screamed higher and how much gold is telling us something bad is likely to happen in the world, the economy, or something is going to happen. People are moving more so, they're kind of moving away from the stock market. Even though the market's going to all-time highs, we're definitely seeing the majority of money moving into physical gold. Ray Dalio was on Diary of a CEO, and he was talking about there's like 5 forces and this 80-year cycle that's at play. And we're coming to this major turning point. We've got internal conflict. We got the left fighting the right in extreme ways. We've got people not trusting the systems anymore, that the government's protecting them. We've got currency problems. So gold is a good representation that we're about to go through this huge life cycle. And it's telling us, physical metals is the place to be. We're in that perfect storm for metals. But we do need to know that when things go parabolic, as you said, and they start to shoot higher, it can end very abruptly, and it might have a big pullback. And a good view of this, we can come back to this chart after if we want, but look at GDX. Look at the large cap gold miners. This is called a parabolic move. It is just going straight up. If we look at silver miners, we have the monthly chart. They're shooting straight up. And if you notice what happens after every straight up move, usually it ends pretty abruptly. The question is, when is it topping? These things are at all-time highs. There's no need to get out yet, but you need to be mentally prepared that, hey, if this does turn, it is kind of a crowded play now that people could unload and exit very quickly and create a very sharp drop. So this is like the bit of the warning sign that when things go straight up, and like I have this huge wave right now of people emailing us and talking about they have FOMO. They want in. They're asking me what stocks and what precious metal ETFs can they buy to take advantage of this. And really, those are the people who aren't in, and now they're willing to pay a premium. They're willing to pay nosebleed pricing, and usually that's a sign we're close to a top. And if I say anything negative on the precious metal space, like we might be coming into a little bit of a blow-off top here, I'm going to get my my head ripped off in the comments, which is fine. But that's one of the indicators that everybody says gold is going to the moon. This is totally different than last time, and every time it is a bit different than last time. But the signs are here. When you look at price action, you don't want to fight this trend. It is clearly up, but this type of move usually ends in a very abrupt reversal and a very long red candle and catches a lot of people off guard. So, it doesn't matter how you look at the precious metal space, money is dumping in. And one other quick aspect here is platinum and palladium have both exploded. We have platinum taking off. And if we look at palladium ETF, these are just the ETFs on them. They have really popped and taken off in the last few days. Palladium, not quite as much, but everybody's just moving into all things precious metal right now. They don't care, and they're piling in. And you just have to be aware. It feels a little crowded of a play. A pause or pullback, depending on how it does that, could be a very bullish sign. It could be an opportunity to get in or add more before it goes higher in the precious metal space. But if it's a reversal type of candle or pattern, you might want to buckle up and protect some profits, because it might actually have a bit of a precipitous unwinding event as well.
Gold is fast approaching a critical target near $4,100, a level tied to Fibonacci extensions and prior resistance zones. Yet, the dynamics of this market hint at the possibility of an overshoot, especially if weakness in equities accelerates capital rotation into metals. When stocks falter, investors often shift entirely into gold, fueling the final stages of a parabolic rise. This phase is powerful, but also dangerous, as crowded trades can quickly flip into sharp reversals. At the same time, the broader investment climate remains cautious. Private equity and venture capital funding have slowed dramatically, leaving mining companies struggling to raise capital despite soaring valuations. Many seasoned investors hesitate to chase after such steep rallies, preferring to wait for corrective pullbacks before committing capital. Still, the technical structure for gold suggests further upside, with silver offering similar potential, albeit with greater volatility. The most resilient play appears to be physical gold or gold-backed ETFs. Let's get back to the interview.
The ceiling for gold, the next level is about 4,100, 4,080, 4,100. So that's kind of where we should be looking for that next upside target. If we look, it's about 9-10%. That's a Fibonacci measured move where it should run into a little bit of resistance. But what happens in this market environment, which when we look at 2007, the comparison, this is where gold could not only hit that target, but blast past it another 15-20% or so. So I do think, that is the gold target, 4,100, but we could have a parabolic move where more people pile in and it shoots higher. And that'll be money probably flowing out of the stock market. We'll probably see stocks falling, and that fuels gold even more. Because first of all, gold's on fire. If the stock market starts to fall, people now don't have to split their money between stocks and gold. They're like, get me out of stocks and I'll put it all in gold. So that first initial big bout of selling in the stock market, that fear, generally shifts all that money and dumps it into gold. And that's what gives that final blow off phase for gold. That's when you need to be aware we might see like a sharp reversal. But I still think there's quite a bit of upside in the precious metal space for gold, silver, and miners. I don't think, I'm not saying it's topping right now. I'm just saying we're getting into this stage where it's very favorable. It could keep moving fast, but you just need to have a game plan for when we hit these capitulation levels. Locking in some partial profits isn't a bad idea. Very parabolic, and then kind of trade sideways for a while and build a launch pad. And that's a good thing. If it can do that, that's great. But typically a parabolic move usually represents whoever's going to get into that asset has got sucked in. They got in because of fear of missing out, greed. They want to get in. They want to catch it. Usually the parabolic moves lure everyone in. And so there aren't a lot of buyers. When it does start to reverse down, everybody who's going to get into it has already got in. So it's really just left with all those people now worried they're going to lose money if they hold on to it. And it can hold its ground. It can, but it generally ends in a pretty strong kind of reverse to the downside. I think there's a couple things at play. When you look at like private equity, you look at like venture capital money, Man, that's spigot shut off a few years ago. It just dried right up. Investors are worried to take on risk. And there is this weird investment vibe that people are, it's more difficult to raise money still right now. And I think that's why a lot of these potential mining stocks are struggling. They have been dormant for a long time. And we're not in an environment where money is just pouring into opportunities. So there's still that. The investment vibe is still very conservative. They don't really want to take much risk. Second, I think the miners have exploded so fast and have big gains that I think a lot of investors are like, well, I don't really want to invest right now because it feels like it's like fairly valued or high valued. They'd rather maybe get into it after it's had like a pullback or something. So they're like, how much more upside is there if the prices have gone parabolic and they're all at resistance or just poking into nominal new highs? It's, savvy investors don't really want to invest after a massive rally. Like that's kind of, when it comes to private equity company, they're not like individual investors who chase high prices. They generally are looking for opportunity, and they don't really want to invest when they're like, well, it just doubled or tripled that individual stock. I kind of don't feel like investing in it right now because I feel like I'm paying a premium, right? So I think there's those two plays in the precious metal space kind of making it maybe difficult to raise some capital. I look at the stock market like the ocean. If we look at a long term, this is the weekly chart of the S&P 500. You need to know a couple things. From a long-term investor standpoint, you need to know, are we in a bull market phase? The stock market is going up. Or are we in a bearish environment where the stock market is going down? So there's a time to own stocks, and there's a time not to own stocks and to move somewhere else. And I use a strategy called asset revesting, which is we reinvest our capital into whichever asset is favorable. And so, we've had a series of these bull and bear market phases, and we're back into a bullish environment. So you need to know if the tide is going up or down. That is number one. Number two is if you go and you look at the stock market from a daily chart, this is the QQQ, you need a strategy that catches these waves through the markets. And I like to think like we kind of surf the markets. Every year, there's about 5 to 12 waves that roll through this bond market, stocks, and various assets. And we want to know when a wave is ending based on technicals and money flow. We want to know when a new wave is starting. And so we're able to just move in and out of the asset classes. We exit the QQQ. We move into a different asset to grow our capital as the stock market falls. And then we can reinvest back into the stock market. And we can play these waves in the market. And so that's what I do. I focus on ETFs. We have 5 to 12 trades a year. We're just rotating from stocks, bonds, currency, cash, and back and forth, just whichever one is kind of moving. And when you go back to 2022, the stock market fell over 20%. The US dollar ETF rallied 17%. And, you want to move to an asset that's going up. Investors, you shouldn't be holding things going down. So that's what I do. We rotate through the markets. We play these unique market scenarios. And, we're getting to this level in the stock market right now that this is earlier this year, just before the tariff sell-off in the NASDAQ. We had this unique market sentiment setup. And this color coding here is using a bunch of different technicals and cycles and money flows. We have a very similar chart pattern unfolding right here that is telling us that we're potentially getting close to a bigger pullback. There's a big disconnect going on in the stock market. And so I'm very cautious here of what we're going to do. We did lock in some profits on our trade last week. So it doesn't matter what happens now. We are long stocks and gold, and those are the plays, but we just need to be aware that these markets will rotate. We have these waves, and you can take full advantage of this market if you understand how to identify these. And it's the same with gold. You can move in and out of gold or the dollar. And I think gold has got some pretty good potential to the upside still. I think gold has more upside. Believe it or not, the charts of silver and gold have roughly the same upside potential. So I would naturally go say, we'll trade gold because it has a higher probability of hitting it, and it has less volatility, meaning you don't have to ride quite the roller coaster, which means you can put more money to work. You can make the same amount of money as silver, more or less. People don't want to hear that. They naturally think silver outperforms dramatically, but really this year, silver has only outperformed gold really just like 8 or 9%. And it has been a hell of a roller coaster ride if you hold silver. So gold to me has got the most. I think it's got 15 to maybe even 30% upside from where we are right now. The stock market, I think it might continue to grind a little higher if the big techs can keep dragging it up. But small caps, mid caps, more or less equal weighted stocks have all hit resistance. So it needs to be the large tech that drag the markets higher. And, they're not showing the strongest kind of sign right now. When we look at the MAGS ETF, let me see here. The MAG ETF is clearly in an uptrend, but it is actually showing a little bit of weakness, short-term weakness that it might want to pull back a little bit. So I think gold, physical gold or a physical gold ETF is the play. And that's where the opportunity I think lies right now.
Gold's trajectory continues to signal that we are in the midst of something bigger than a short-term rally. The consistent series of higher highs, supported by moving averages that remain firmly upward sloping, indicates that long-term money flows are still intact. What matters most here is not chasing every tick of the market, but understanding the broader cycle. When an asset aligns with both short-term and long-term trends, the probabilities shift dramatically in favor of strength. Precious metals are showing precisely that alignment, a sign of capital rotation that is difficult to ignore. In these moments, discipline is everything. The noise of daily price swings or emotional reactions to sudden surges can distract investors from the larger pattern. However, history shows that the strongest bull markets are often accompanied by pauses, consolidations, and then renewed strength. Each breather is not a weakness, it is the foundation for the next leg higher. For investors, this means focusing less on prediction and more on preparation, protecting capital, managing exposure, and being ready to act when the next breakout confirms itself. The world is undergoing profound financial shifts, and gold, silver, and related assets are once again benefiting from this transition. Staying patient while respecting the risks is what separates lasting success from short-lived speculation. These cycles will not wait for those undecided. Positioning wisely today could make all the difference in the years ahead. Share your thoughts on ChrisVermeulen's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.